Hello, this is Tim Congdon, and once again I am updating you on the global monetary scene, but also discussing broader issues about monetary policy and the role of banks in macroeconomic instability. Let's just go back to some basics. There's a very clear relationship between money and the growth of national income. Roughly speaking, the growth rates of money and nominal national income rise by very similar amounts over periods of 5, 10, 25 years. That's true of practically all economies. That's very important understanding what I'm about to say about the United States of America, what's going on there at the moment. There is at the moment a very clear slowdown in monetary growth, which has got implications for the American economy and the world economy in 2017. But let's just go back to these larger fundamental issues. In the interwar period, there was huge volatility in monetary growth in the United States, with in particular a collapse in monetary growth in the early 1930s, which has been widely attributed to, the Great Depression is widely attributed to this breakdown in money growth and the problems inside the banking system. And there was this very famous thesis put together by Milton Friedman and Anna Schwartz in a 1963 book, which set out a monetary interpretation of the Great Depression. Now, you can see this here in the chart, you can see this huge dip in the middle. You might then say, well, surely that couldn't happen again. Well, in fact, the same sort of thing happened about 10 years ago now, almost 10 years ago. In the Great Recession, we saw these sharp fall in the rate of growth, the quantity of money, not just in America, but also in the Eurozone and in Britain. And in my view, that was the fundamental cause of the Great Recession. So this is a general story. It's something that one finds time and time again. I've got a book coming out in June where I'm going to be presenting. I've edited this book, and it's going to be arguing a number of the essays, not all of them, that a change in money growth, a fall in money growth, was the driving force behind the Great Recession of 2008 and 2009. All these debates are tied up with the prestige or infamy of the capitalist system, because many people say, in my view wrongly, but there we are, that the capitalist system suffers from inherent instability because banks are liable to go bust, etc. Now, this then raised the question of why the rate of monetary growth changes. Why was there this sharp fall in money growth in America, the Eurozone and Britain in 2008 and 2009? And why indeed did American quantity of money actually fall heavily in the USA in the early 1930s? Nowadays, most money takes the form of bank deposits, so it's very important to analyse what's going on inside banking systems. And there's this tendency to say that the reason that things went wrong in the early 1930s and again in 2008 and 2009 is that banks went bust, and then they couldn't sustain the business that they were doing, so their businesses contracted, deposits fell, and so on. Now, this is a fair comment on America in the early 1930s. It's still true that the Federal Reserve could have countered the downturn in the economy by sufficiently aggressive action to stimulate the quantity of money and bolster the banking system, but that's not what happened. So that's not true at all of what happened in the last recession, the Great Recession of 2008 and 2009. Recall from my last presentation, the last monthly presentation, that you went through some of these figures on the losses and profits of the American banking system in the most difficult period. And let me just remind you of some things I said there. It's true that there were massive losses in a sense suffered by the American banks in the most difficult period. Losses of $176 billion. But it's also true the American banks have huge ongoing profits from their businesses. They charge obviously higher interest on their assets than they pay on their liabilities. So overall, there was only one year of losses by the American banks in the last recession, and overall the American banking system remained profitable, solvent, well capitalized and so on all through the Great Recession. So if you want to understand why the quantity of money fell in 2008, it's not because banks went bust, they didn't go bust. It's not either because the Federal Reserve tightened policy by raising interest rates. On the contrary, interest rates were slashed to zero. So why was there this fall in the quantity of money, or fall in the rate of growth in the quantity of money in that period? And the answer is a tightening of bank regulation. This comes as a surprise to people, but that was the fundamental reason why money growth fell so sharply. Essentially, the regulators required the banks to hold much more capital relative to their assets. The banks couldn't add their capital quickly. The stock market was very weak, so they couldn't issue new stocks and shares. They couldn't retain from profits, partly because they did indeed have some losses on their loan books. So the only way they could comply with the demand to hold more capital relative to assets, to reduce their assets, the assets go down, so the liabilities are mostly deposits, they're mostly money. So the tightening of bank regulation led to a fall in the quantity of money. This puzzles many people, but it's a key argument in my view about the whole period. And I might then ask really, this is not that difficult an argument. It may not be a widely accepted argument for the moment, but it is understood by many people, including, may I say, by many top policymakers. We know that because actually the Bank of England eased the capital requirements on the British banking system last summer when there were worries that Brexit would lead to a recession. Very interesting that. 2008, my view, quite the idiotic thing to do, but they did it. They tightened capital requirements to deal with the Great Recession as they saw it at that time, to make the banks safe. Summer last year, worries about a recession because of Brexit. They eased capital requirements. Okay. Hardly consistent, is it? But you might think then on this basis that the regulators, policymakers, central bankers and so on, all the economists advising them, all of the very clever people, the civil servants, politicians, and think about this topic, would never do that kind of thing again. Well, look at this chart. This shows you the rate of growth of the loans and leases in bank credit, effectively lending to the private sector, of the American banking system since the middle of 2015. You can see it's quite strong in the early period there. It's up to figures like 6, 7, 8% at an annualized rate. And then it tapers away. And in the last few months, it's dropped to nothing. So we have another sharp slowdown in US credit growth. Somewhat similar to what we saw in 2008 and rolling on into 2009 and 2010. That's not good news, is it? We then ask, why is this happening? Well, the American banking system has got obviously large banks and small banks, and the Federal Reserve very helpfully splits out the numbers for two types of bank. And you can see here that the collapse in the rate of growth of loans and leases in bank credit is much more marked at the big banks than the small banks. Small banks still growing their balance sheets quite happily. What's going on here? The answer is that there has been a change in regulation since late 2015, applying particularly to what are called global systemically important banks, GSIBs, which have got to have much more capital relative to the assets than the smaller banks. And they have to move to this new regime starting around about the middle of last year. So that explains why there is this discrepancy between the large banks and small banks. It's regulation. It's regulation that's causing this slowdown in credit growth, then causing the slowdown in money growth. Yes, we're going through it all again. Should we get too concerned about it? Well, yes, we should. It matters in various ways. It matters because all the talk of a Trump boom in 2017 is going to be wrong. All that talk is baloney. It also matters because it tells us, I'm afraid, that the policymakers still don't understand that if you change the regulation of the banks drastically in a short period of time, that will affect the growth rate of their balance sheets, that will then affect the rate of growth of quantitative money, that will then affect economic activity. And if you don't want to have another recession, you don't do this kind of thing. All right, let's just then move on and think a little bit more about this. Is there going to be another global recession? I don't think so. Happily, what's going on in America is a little bit isolated. If you look at other countries, the situation is a good deal more satisfactory. I wouldn't say I get too relaxed about it all, but it's more satisfactory. In fact, if we look at, we've got here a table where I try and look at all the economies, and you can see that America's output is somewhat smaller than that of China nowadays. China imports more than America does. And in China, money growth is high and stable. In the Eurozone, money growth has actually picked up towards 5% a year in the last few quarters, having been very, very low in 2012 and 2013. Japan has got some of the highest money growth numbers in the last 20 years. Not very fast, but under 4%, but still the best for 20 years or so. India's all right, having had this rather crazy demonetization exercise last November. And Britain also is seeing a slowdown in bank credit at the moment, but we're relatively unimportant in the global picture. So, yes, the slowdown in credit growth in the United States it is a matter of concern. It does mean that there won't be a strong year, in my view, a strong year for the US economy in 2017. But it's only one element in a larger picture, and I'm still relatively relaxed about the global economic outlook for 2017, looking at the world as a whole. We've just had elections, presidential elections in France, the first round of those elections. A lot of alarm and excitement in the newspapers about possible runoff between a very left-wing candidate and a very right-wing candidate, but in fact it seems to be almost certain that Macron will be the new president, and he's very much a centrist, sort of modern kind of candidate who won't, I'm sure, rock the boat. The much more serious worry for the Eurozone, in my view, is Italy, where the banking system is running up debts to the so-called Target 2 interbank settlement system run by the European Central Bank, and the gap between the credits of the German banking system, the German economy, and the debits of the Italian banking system, Italian economy, has reached an extreme, as you can see from this chart here. I don't have time today to talk about that anymore, but this will be the theme of the next presentation. We've got almost certainly some Italian elections coming up, if not later this year, early next year. They're supposed to have the next elections before May 2018. And this is going to be a much more difficult election than the French one, because the Italians are in much more difficulty in terms of their indebtedness to the European payment system. They have got a much larger public debt than France relative to GDP, and politically the opposition, the growing opposition to the single European currency in Italy can hardly be overlooked. So I'll return to that topic next time, but for the moment I've been concentrating on the American situation, and I suspect there'll be more discussion about the American credit slowdown in coming weeks. Thank you very much.